morning, everyone. So sorry for the delay this morning. Welcome to our webinar, Securing the Future, Nationwide Care Matters Long-Term Care Solutions with Ames, Nisha Catron, and Nationwide's Cass Barnes. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, April 1st at 9 a.m. Pacific Time. Join Ames Mike Anderson and Mutual of Omaha's Bill Beckett for a conversation on Medicare, Medicaid, and long-term care insurance. And with that, I'll hand it over to Cass so that we can go ahead and get started. Take it away, Cass.
Thank you so much. So I am Cass Barnes and I am with Nationwide. I am the CareMatters, basically I'm the national internal consultant or your wholesaler. So today we are going over some differences between CareMatters, two CareMatters together, and how we can use those for helping our clients plan for their future. So diving right in, of course, important things you should know. We've known these, we love these, we know what they say, moving on. Other important things you should know, slide 2. Again, we can get back to these, but keep on going. Make sure that we see these, we read these, and we'll start with the agenda. So today we're going to provide a general overview of nationwide solutions for ensuring long-term care needs for our clients. Now, when we begin with a quick look at Nationwide's evolution into LTC product development, we will discuss the value of doing business with Nationwide and, of course, our CareMatters cash indemnity benefit policies. And we will briefly discuss how CareMatters works and where it fits best with your client opportunities. And then finally, we will look at a few, oh yes. Can you hear me?
It's only showing the cash indemnity, the PowerPoint. It's not showing what you're reading.
Oh no, hold on one second. Let's try this. Okay, let me get out of here. How about, let's pick this one. How about that one? Can you see my agenda?
Yeah, I can see your agenda. Thank you.
Beautiful. Yes, of course. Thank you so much. So again, we're finally going to look at the few sales ideas at the end that can be used with our nationwide LTC solutions. Can we see the 6 now?
Yes.
Perfect. Okay, good. I just want to make sure before I get on a roll. So Nationwide has come a long way since we rolled out our original LTC rider almost 25 years ago when I was just a babe. So since our beginning, we have added upon and improved our lineup of LTC solutions. But the one thing that has stayed constant, of course, is our belief in the cash indemnity model. So we've always been cash indemnity. So from very get-go, we had the LTC rider on the individual life insurance products. We then discovered our nationwide Your Life CareMatters, which we still have. It's still in the state of New York. We kind of refer to it as CareMatters 1, or of course the Your Life product. We then evolved into the LTC rider on survivorship life, which kind of dove in a little bit and paved the way for our CareMatters 2 product. Before we went there, we had the LTC Rider 2 on the individual life insurance products. And then lo and behold, Nationwide CareMatters 2 flushed out. I want to say it was 2019 when that finally rolled out. And then Nationwide CareMatters Together is our newest babe of our product line. And that came out a little over a year and a half ago. So that is our most newest joint hybrid model. So we've come a long way in those years. Now, what does cash indemnity even mean, right? So first, it means that the full available monthly LTC benefit will be paid. I don't need to see receipts. I don't need to see doctor's notes. I don't need to see anything showing me that you spent the money to get your money. It is your money. So you do not need to do anything other than start a claim, set a plan of care to start to get that claim in order and get that money monthly to collect those benefits each month. Now, there are no restrictions from Nationwide on how your LTC benefits are spent, which means that 100% of those benefits can be used to pay family members or other informal unlicensed caregivers. Alternative care services can be used without need for approval, and expenses such as prescriptions, home safety modifications, lawn care, things that we just don't think of. We just kind of typically think it's just for medical care. But in this case, that's not so. These are things to help keeping you in your lifestyle and that help make things easier for you. You can use the money as you like because it's your money. So there is a value to the flexibility of cash indemnity when needing care, especially with an unexpected situation or environment. And with you collecting the full amount of eligible benefits, you can also save unused benefits for the future, which can help reduce future out-of-pocket expenses, or you can leave the remainder even to heirs. Now, please note that LTC regulatory requirements must still be implemented by the insurance company. And like I mentioned, every year we'll do an annual recertification to make sure that the claim is still active, and there will be a submission of a plan of care once that claim goes into effect. Now, CareMatters 2 is a linked benefit LTC solution. So it sits on it sits on a universal life chassis. So there are several ways to pay for the policy, which varies by a couple of the different versions, and we'll discuss that as we come into the other features. But for this example, we'll assume that a single pay, but we'll keep the example generic just to keep it simple, right? So a choice of benefit periods vary anywhere from 2 to 7 years. The sweet spot tends to be a 6-year benefit, and that's what we'll use in most of our descriptions today for all of our examples. So the 6-year benefit plan is sold as a 2+4 option, if you will. So this first bucket here is a benefit pool. This sits as your acceleration of death benefit. That amount that is available for both the long-term care benefits and death benefits are designed to last 2 years for long-term care benefits. Now, this bucket must be exhausted first when going on LTC claim. And then once it's used up, the insured is still on claim. They begin collecting from that second benefit pool or that second bucket sitting there. Now, this is the extension of benefits rider, and it's available for long-term care benefits only. It's designed to last 4 years in this example, or however long it takes to complete the elected benefit period. So the total benefits available for LTC is the total of the 2 benefit pools. So again, in this example, it's 2 years plus 4 years for a total of 6 years. So once the insured passes, the greater of the guaranteed minimum residual death benefit is still there. And this is the amount that can move on to beneficiaries. So you see this residual death benefit down here. This is available whether you have used the whole pool or not. And it's 20% of the specified amount in every other state but New York. New York is 10%. Speaking of New York, let's dive in just a little bit. So for any of you that are selling New York, Your Life, CareMatters, there are some differences. The issue age is a little bit older, so it starts at 40 instead of the CareMatters 2, which is 30. We still have the retroactive elimination period. So there's the 90 calendar days, and then we will go back and pay from day 1. So they will get months 1, 2, 3, and 4 on that 91st day of claim. The return of premium feature, there's only one option on the New York CareMatters. There are 3 different premium features, which we'll get to later on the CareMatters too. 2 inflation options on New York, 3% simple and 5% compound, and 4 inflation options on our CareMatters too. So we've got no inflation option, 3% simple, 3 comp, and 5 comp. Again, I've mentioned the death benefit with the specified amount is 10% for the guaranteed on New York, 20% everywhere else. The annual monthly mode is the same benefit, same on both accounts. Now in New York be New Yorking, and everybody gets the couple rate, individuals too. So there's nothing to kind of break down there. Now with the CareMatters 2, there is an individual and a couple rate. The discount usually ends up being about 5%. So if they are married or they are in a coupledom or domestic partnership, anywhere that they can show that maybe they are relying on each other, we can look at that as a couple. LTC benefits are the same, whether the total premium is paid as a single pay, 5 years, or 10 years in New York. It'll be a little different on the CareMatters too. In this situation, cash is king. So when you're paying a single pay, you're going to get a little bit bigger bang for your buck. It's just slightly. 5 years, 10 years, pay to age 65 or age 100 are the options for the CareMatters too. Like I said, you'll get a little bit bigger bang for your buck on the single pay, but it all stays pretty relative and it keeps it very affordable for our clients. Unfortunately, in New York, it is not HSA eligible or tax deductible for any of the premiums. Of course, we know life is not touchable, but even the LTC premiums are not HSA eligible or tax deductible in New York. And in CareMatters too, everywhere else, those LTC premiums are HSA eligible and tax deductible because we're able to show the separately identifiable premiums. So we can show that being broken out, and therefore it can be used for tax purposes. Then comes the newest babe, is the CareMatters Together product. So when choosing a CareMatters Together, we have 3 options for length. So we have 48 months, 72 months, and 96 months. Now we know that 96 months is 8 years, but the way I like to think about this is these are the amount of payments that you're going to get because it's a shared pool. So you have 48 payments, 72 payments, or 96 payments. And of course, one person could use all of those payments. You might split them 70-30. You might split them half and half. Maybe none of you use any of it, and that full death benefit would still be available, but it's a shared pool to use. Now, if either applicant is rated as standard, and this is where I like to point this out, so the second half of this page. So when one is preferred and one is standard, which one of them has to be preferred in order to be on CareMatters Together. If either applicant is rated as standard, the policy works a little bit differently because it's also a little bit more expensive because that standard person is going to cost a little bit more. So we have a 48-month or 48 payments, and it all sits in that acceleration of death benefit rider. Anything after that, the 24 on the 72 or the 48 on the 96 becomes the LTC extension of benefits rider. And the reason why I point this out and why I always make this succinct, right? Quickly, I'll talk about it. If we're talking about international clients, if we know that our clients are going to retire in Nicaragua, for example, we can, if one is preferred and one is standard, they could get the full 48 months of benefit internationally. If one is, or if they are both preferred, they would have 36 months that they could get paid internationally. That 12 sitting there, that LTC extension benefits rider, they would have to come back to the United States to get that last 12. I just know it's a bigger sales idea happening more and more, that we're getting more and more clients that are planning on retiring outside of the States. So I just wanted to always bring that up. Now, with the cash indemnity, we can pay out more than our reimbursement counterparts. So the cash indemnity policy in this situation here, let's say it's paying out $8,000 a month for 48 months until a death has occurred. The total received with the $384,000, and that does not count any residual death benefit that may be applicable. Now, however, because a reimbursement policy only pays the cost of actual contract qualifying LTC expenses, maybe over that 48 months, this policy only paid out $192,000. And because the monthly expenses only added up to $4,000 a month, that is all that can be reimbursed each month. So we can't pay, or we can pay more, the reimbursements cannot. They can only pay out receipt for receipt, match dollar for dollar. And that way, in this example, what this is showing is that the cash indemnity policy paid out way more than the LTC benefits. In fact, the cash indemnity paid out an additional $192,000 over the reimbursement plan. Now, kind of diving into some funding options and different sales ideas here. Of course, there's cash, which we can use from savings, CDs, bonds, maybe some extra cash from selling a home or a business. You can definitely, obviously, use that to fund CareMatters. Income, this is one of the more popular ones, right? So income dollars available from any excess salary, unneeded, or income from investments, and Social Security income. So income tends to be still working years, right? Maybe I see someone coming in, maybe age 48, maybe they're already dealing with a parent that is needing long-term care, or maybe they are the caregiver to a parent. This is usually sitting forefront on their mind. So maybe we start to bank a little bit of the income, set it aside, maybe do a 10-pay. Also looking at assets. So maybe we're looking at sleeping assets, maybe we're looking at debt assets, or assets not needed for retirement income. So maybe there's a 401k, an IRA, qualified or non-qualified annuity that we can move and push into the CareMatters. With these ideas, I always like to point out, make sure that the client is 59 and a half or older to avoid any early withdrawal penalties. So this is a sales idea that might come into play if we're looking at 59 and a half. Linked benefit policies for the affluent. Now, I always hear, but why would I buy this when I can self-insure? And we always come back, well, let's self-assure. High net clients are often reluctant to purchase LTC coverage, and it's due to the perception that they can afford to self-insure, which they can, in theory. So if we're self-funding, which is a more accurate description of what may or may not be the most efficient solution. So another way to deal with potential LTC expenses might be, like we talked, self-assuring. So by leveraging the insurance dollars for LTC, we know that we will eventually be able to receive back the full value of the asset if needed. So using a hypothetical example, and small numbers, we'll keep it simple. So if you're going to self-insure, we might consider placing 100K in a secure liquid investment, right? Upon needing long-term care, we would then spend that 100K plus a little bit of its growth on those expenses. Now, if we are still alive after going through that 100K and we still need care, the savings is now gone. And we would now have to start tapping into other personal resources, right, to continue paying on those long-term care bills. However, we take that same 100K, reposition it into a CareMatters policy, and knowing that you can still eventually retrieve if needed, it still has cash value, it still can be liquid, but essentially upon needing care for that first 100,000 of benefits, that would be coming from your premium dollars. But once that 100K is used up, you have a stop loss of sorts, right? Because the next 440,000 in the policy is additional benefits that are available to pay for your long-term care expenses. And that will come from this policy versus any assets. So in addition, there's a guaranteed residual death benefit that can be left to heirs. That amount, again, will be 20%, 10% in the state of New York. Now, using excess income available to pay for a CareMatters policy may be a better strategy for, well, clients with excess income available from salary. So it may be easier to access than an asset. And they may also have income earned from the portfolio that is available to use to purchase a policy. So these clients may be concerned with large withdrawals from portfolio, whether during a down market, an up market, or just maybe our current market. So if we're looking at the current concerns, there might be some pushback on that withdrawing for a single premium. But we all know that dollar cost averaging has been proven time and time again over the years to help with that investing on a monthly basis versus trying to time the market just right. So the results in better performance of the portfolio. Now, when it comes to funding long-term care coverage from portfolio assets, we can also consider the reverse concept. So reverse dollar cost averaging here. Reverse dollar cost averaging allows more of the portfolio funding asset to stay invested longer in an up market and have it continue to grow. It could remain in the portfolio during a down market to recover, and it could also provide immediate leverage in a stagnant market. So clients who value the death benefit leverage in early years of the premium payment schedule, for example, the client may still have a small death benefit need for just a few more years because maybe the house isn't quite paid off, or maybe the kids are still in college. So it's still a safe way to hedge if those are still concerns. And those first several years of the policy will see a nice death benefit leverage, especially in the IRR. So because there is no model factor, the policy benefits are the same whether you pay annually or monthly. It is a fixed and guaranteed product. So full leverage of the policy is captured upon the first monthly payment made. So the moment that you make that first initial premium, you have access to that full bank, that full pool of long-term care. So here we're showing 10,000 premium paid in for 10 years. And as soon as that first premium is paid, like I said, the immediate leverage is had. And there's no market volatility risk because the linked benefit policy is an asset that is not tied to the market. It is fixed, it is guaranteed. What you see is what you get. So plus it is an asset with a known result at all times. Of course, assuming that all premiums are continued to be paid and there are no changes to the policy, no loans taken out, et cetera, et cetera. We know the drill. But as you can see, anyone looking for a few years of life insurance coverage is getting decent leverage on the life versus premiums paid, especially for the first 7 years. So another sales idea that I have been seeing a lot of is using your IRA distributions to help fund CareMatters. And this can be done a couple different ways. Yes, you can definitely roll it over into a CareMatters too. I've also seen it being done a lot with a CareMatters together. So we will take an IRA, put it into a SPIA, 10-year term certain, and have that 10-year term certain pay for 2 lives. So that's our loophole to pay for both lives from an individual policy. Again, making sure that they're 59 and a half if this is something that we are considering. And I also mentioned this 90-day calendar retroactive elimination period. So all versions of our Nationwide CareMatters 2 have this 90 calendar day retroactive to 0 elimination period, which is different than the LTC rider. So any LTC rider on any of our products does not have the retroactive payment. It starts on day 91 and goes from there. CareMatters 2, CareMatters Together has and CareMatters Your Life New York also has that 90-day retro. So in this example, we show a client eligible for $10,000 a month. That's their benefit. And they won't receive any benefits in month 1, 2, or 3 because they're still in that elimination period. But day 1 of month 4, their claim will be processed and they will receive the benefits for months 1, 2, 3, and 4 for a total payment of $40,000. And then after that, the monthly benefits will go back to $10,000 a month and will be paid as long as the insured is still alive and continues to be on claim. So looking at this example, we're looking at the reduced paid up option. So I understand that life happens. So maybe we come to a point in our paying years of the premium and we can no longer make any further premiums. So in this hypothetical example, after the client paid premium for 6 years, they've asked for a reduced paid up policy and they will retain 60% of the death benefit and their long-term care benefits. So they will prorate those 6 years of premiums paid. Now, the new reduced LTC benefit continues to inflate and grow at a 3% compound. And by age 71, it has actually grown back to the original amount and it keeps inflating upwards. So this policy is now guaranteed and paid up without much detriment to their long-term care pool. So I mentioned that we would talk about the return of premium options. And again, this is only available on the CareMatters 2 product, not in the New York Your Life and not on the CareMatters Together. There's only one option for that. But when we're looking at the CareMatters 2, we have the 3 return of premium options. And first is the vested ROP. Invested over the applicable period will be 100% available based on the premium schedule. And this option provides the most return of premium in the early years, but of course, less LTC benefits. The other option, one-time step-up ROP. With this option, the policy owner has 80% of return of premium for 10 years, and then 100% return of premium on day 1 of year 11. This option also will provide less ROP in early years than the vested option, but has slightly better LTC benefits. So good, better, best in kind of the situation here with the long-term care benefits. And then of course, the maximum LTC benefit, minimum return of premium. So the ROP here is equal to the surrender value. This is the most popular option since it provides the highest long-term care benefits. This option provides the lowest refund of premium value in the early years while providing the most long-term care benefit for a given premium. And that's what this product is built for. It's built to have the max pool available to our clients. The cash surrender value here will be equal to the policy's specified amount on the maturity date of the policy. More often than not, rarely do I see the vested, and that's, if we're going to go with a one-off, I would say it's usually the vested ROP, But anything that I'm designing, more often than not, of course, because that's the way it's built, is that maximum LTC benefit, min ROP. When you're illustrating, that's typically what the default is. So more time on cash indemnity. So some sales opportunities will generally only work with a cash indemnity benefit model. So for example, maybe it's an uninsurable spouse or partner situation. So maybe someone doesn't have or is not in the greatest of health, or maybe they got a diagnosis a few years back and they're now getting it under control, but maybe they couldn't get a policy on their own, or maybe they can't get a policy at all. The LTC benefits being collected from the insured who is insurable on the claim can also, those benefits can be used to help pay for the care of an uninsurable spouse, because there are no limits from Nationwide as to how the benefits are used. So you could take that money, bank some of it, and use that to help the uninsurable. Second point I want to point out here, I just scrolled up and fast through. The employer-owned policy is supplying the long-term care benefits to an employee. Now, cash indemnity makes the process extremely simple. So once the claim is approved, full LTC benefits are sent to the employer, who passes the benefit on tax-free to the employee as accident and health benefits. Reimbursement plans are technically possible, but they're not always practical, because now we're waiting for reimbursement, and now we're collecting receipts, and now we're collecting medical information. So this would require the employee to submit receipts each month to the employer, who would then submit them to the insurance company, and then the insurance company would pay the employer. So it's just a lot more hoops to have to jump through, where ours is just more streamlined. You need the cash, here's the cash. That's all there is to it. And then also for estate planning with an LTC rider, so keeping with an ILET. So this is where cash indemnity can also work best. So for an irrevocable life insurance trust, we're putting the LTC rider or the CareMatters into it. This becomes part of the estate plan, helping to avoid paying unnecessary estate taxes caused by a self-funding plan, right, that is never utilized. And when the unused savings are left in the estate, they're subject to estate taxation. I have a white paper on this that I could send out to. You could also pull it from our nationwide files on nationwidefinancial.com. So back again to the uninsurable spouse or partner. So how do we help clients who are uninsurable for long-term care? So there's a few ideas that can help mitigate some of the potential expenses. Now, if the client has a healthy spouse, one strategy would be to insure the healthy spouse with a cash indemnity policy that pays cash indemnity benefits. Full long-term care benefits are paid regardless of the insured's LTC expenses. So if $12,000 is your monthly benefit and you're only using $5,000, you can bank the rest of that and use that for a future spouse's care, or even your own care, to help extend the policy. Providing care may cause the healthy spouse to see a decline in his or her own health, as we know. So then they would also need care. So upon the insured needing care, the LTC benefit, when paid by cash indemnity, can be used to help pay for both spouses. Thus, if the insured is on claim, these funds could also be used to help pay the care expenses of the uninsured spouse, like I mentioned. And if the insured needs care first, then the unused benefits, again, can be banked into a personal account to be used later by either party. Reimbursement plans will not work in this scenario. So it's a nice plan B or C in that option. So further funding for a long-term care solution. You can fund with assets or income sources. And this is where we tend to see works best for some of these different demographics. So clients may appreciate being able to reposition an asset instead of making an expense when possible. So this chart provides some options for funding and where these options may best fit for your client profile. So maybe it's that CD that's maturing, or a recent inheritance, maybe a bond that's matured, or basically anything that's called as an excess, maybe like an annual liquidity that you could use, but all funding options for clients of any age. Now, peak earners with excess income generally fall into that 40 to 65 range. So this is when we could maybe put aside dog-ear sum, put it in, do a 10-year 10 pay, and then they can kind of set it and forget it. For the pre-retirees and retirees, income from assets or non-qualified annuities not needed for retirement income may supply funding for your LTC solution. So this group of clients may also have funds from the sale of downsizing or selling a home, or maybe they have like low yield assets they would like to make better use of. What I have seen a lot of more recently in the past year, maybe it's an old VUL that just isn't performing the way that they had originally anticipated, and we can roll that 1035 into a CareMatters policy. So just making better use of a sleeping asset, dead asset, just something that isn't serving us any longer. And for retirees with Social Security benefits not needed for retirement income, this monthly benefit could also be repurposed into LTC coverage. So Nationwide Long-Term Care Solutions offers your clients a flexible way to ensure long-term care, customizable features, choice of benefit period, your inflation options can keep this all affordable and flexible for your client, and the cash indemnity benefits. It allows for informal and family caregivers and also pays a minimum death benefit even if every penny of that long-term care pool is used. So long-term care planning is part of a good and comprehensive retirement planning conversation. It protects income, it hedges the assets, and using Nationwide LTC solutions provides you and your clients flexibility, simplicity, and ingenuity. My final slide here, all of our famous numbers. So we have our Solution Center, the Nationwide Financial Network Solutions Center, and of course there is my information there if you should ever need to reach me, email, or phone. Do we have any questions?
Yes. So in regards to underwriting,
Yes.
are you guys flexible? Have strong restrictions? And what does it look like for smokers and non-smokers? How do you rate those?
Yeah, of course. So our underwriting, it's simplified underwriting for this product. So we will not ask for labs, blood work, that sort of thing. So and what we'll do is a medical interview. If they are over 60, they will also do a cognitive screen. Once we get that in, it's a 4 to 5 day process looking at that. And it is I would say it's more lenient than most, especially under life. We're actually bringing a lot of, I know a lot of companies deal with like a Lumifin, but we're bringing our underwriting much more of it in-house. So that way we have more say in what stays and what goes, right? So we kind of can, yes, we have a guideline. Yes, we have a pre-qualification guideline that you could take a look at and see where they might fall. We could always do a pre-screen, easy peasy, send it in. We can give you ahead of time. Yes, you can submit. Yes, we would consider, or maybe not at this time, or when we could resubmit. So that all stays in-house, which then makes it flexible that we can look at it at a case-by-case basis, right? Maybe we come back with information. Maybe something showed up in the Milliman script because of the way the doctor ordered something. We can take a look, right? It doesn't have to be an automatic decline. So I would say very flexible underwriting, much more lenient than what it used to be. I know we are actually rewriting the guide. So things that used to be an immediate decline, say diabetes 1, isn't necessarily a decline right off the rip. Did I answer all of that?
Yeah, yeah. And then, so in regards to CARES Together and then CARES Matter
Mm-hmm.
2, what are
Yeah.
the significant differences in those products?
The significant differences in the CareMatters 2 and the CareMatters Together would be length, the duration. So with the CareMatters 2, max is 7 years. So each individual could have 7. Where the CareMatters Together is a shared pool, and it's 96 payments, or for this conversation, we'll say 8 years, right? So it might look like a shorter pool. I don't like to throw stats, but we know that men on claim tend to be on claim for 3.5 years. Women on claim, once they start claim, tend to be on 4.5 years, hence the 8 years. That's where that comes from. So I would say that's the biggest difference right there, is just the length of time, benefit duration. 1. 2, other big difference is the waiver of premium that sits on the Together versus the 2. So there is no waiver of premium on the CareMatters 2. You would have to continue paying the premium, life and LTC, in order to maintain benefit, full benefit, or it's going to drop to that reduced paid up option. On the
while on
CareMatters
claim.
while on claim. Now they could use the money, they could use the claim money to pay for that premium, but they would have to continue making premium payments versus together. Now, if my husband and I are on a CareMatters together policy, let's say we're on a 10 pay, and my husband, I always make my husband, maybe it's me, but for the sake of argument, my husband goes on claim year 8 of paying that premium, and he stays on claim 8, 9, 10, continues on claim. We would not have to go back and pay 8, 9, 10 ever, and it would be considered paid up in full. So there is full waiver of premium on the CareMatters together. I'm hoping that eventually it gets revamped on the CareMatters 2, which there is discussion of adding that on later. But as of right now, those are the main big differences. And of course, the return of premium. There is no return. There's only one option of return of premium on the CareMatters together, which is the max LTC, which is what it's built for.
Okay. And then out of the 50 states, do you know off the top of your head which states your product is not in?
Montana.
I know for sure Montana.
Montana.
Only
Someday, just not yet. Yeah, Montana is odd man out, so nothing in Montana for the CareMatters suite. Although I know, and this is not my realm, but I did get excited about it because it's kind of a gateway, right? So the long-term care rider, so the LTC2 rider, which is our newest rider, is now in Montana, which therefore leads a gateway into the CareMatters product. Same thing kind of just happened in New York because we just launched the CareMatters or the long-term care 2 rider in New York. So we're hoping for a little bit of a gateway. So full CareMatters products, all states except for New York. New York only offers the year life. Montana offers nothing. California now offers the 2 and together, which we just launched together in California mid-January.
oh cool. Okay.
I made a very simple question, a very long answer. Sorry.
No, you're good. You're good. And then
Long answer, yes. Long story
and
short.
then yeah. So with agents wanting to contract with Nationwide, what is the time frame?
So agents wanting to contract with Nationwide, I would say if we're looking at this, maybe about a 14-day window. So depending on who you are clearing with, who your brokerage is with, we would get that information, get it cleared, make sure that the long-term care requirements are met. That goes into the system. Pretty quick turnaround from our licensing department.
Okay. And then do agents need to be contracted to access the quoting system?
Ooh, say that. I'm sorry. I'm in the office today and it's a little loud here. No, you're fine.
No. If agents want to at least start the quoting, would they be able to access it, the portal, or is it behind the sign-in wall?
It's behind the sign-in wall. So they would need to be, right, they would need to be appointed. If they are curious, right, there's a quick quote that's out there that they would not need to be appointed for, and that's out available without having to sign on. And I can send you that because there's a password that just needs to happen, and that's just, I think it's NWF 25. So, but I can send you that. But that if you're just looking to like, I'm curious to see what this would look like, they have access to that.
Okay, and then a new question came in. Can
Yeah.
licensing be done separately from life and annuities?
Can licensing be done separate from life and annuities? Good question. And I don't think so. I've only ever seen it tie because it is a life product.
Yeah.
Right. So it would have to be, so not necessarily annuities. Depending on the state, life, yes, sometimes life and health, just depending on its requirement.
Okay.
But yeah, I've never seen LTC just come in on an LTC.
Oh, got it. Yeah,
Mhm.
I
Mhm.
understand. That's
Right.
all the questions that I have, and that was the one that just came in. Does anybody else have questions before we let Cass go? I'll take that as a no. A long pause. Well, thank you,
What was it?
Cass.
Oh, yeah.
Um, I was just like, thank you for taking the time out today. Definitely look forward to working with you in the future. I really appreciate you explaining um, this wonderful product. I do definitely like it, especially on the international side as far as people retiring. And yeah, if you want to reach her, her information is on the screen.
Thank you all so much. Yeah, if you need anything else, Nisha, just let me know. I'm always happy to help.
Okay. Thank you, Cass.
You're so welcome. Have a great day.
You too. Bye.
Thanks. Bye-bye.